Hey guys, it's Connor from Founded here. Welcome to my channel. In today's video, I'm going to answer one of the most popular questions that I received from viewers, friends and family, and that is whether or not you should pay down your mortgage or invest the money instead.
I need another extension on my mortgage payments.
This question usually comes after unexpectedly receiving additional money outside of what you would normally have, such as an inheritance or a workplace bonus. In today's video, I'm going to look at all the reasons for and against paying down your mortgage. I'll also share a real life case study that I addressed with one of my own personal financial coaching clients. And in case you're wondering, the answer of this question depends on several factors, but it will always be 100% dependent on your personal financial position. However, in this video, I'm going to look at all the reasons you might want to pay down your mortgage, invest the money, or do something else entirely. Whatever choice you ultimately make, taking action and putting your money to good use is always the right answer. What are the reasons to pay down your mortgage? Firstly, security. Knowing that you'll always have a roof over your head and this peace of mind that comes with that is touted as one of the top reasons to pay off your mortgage. And even if your current lump sum isn't anywhere near enough to pay off your mortgage on its own, consistently focusing on the overpayments and maintaining that over a period of time will help you to pay down your mortgage well before the normal term. And by paying down your mortgage early, you are reducing the total amount of interest that you must pay on the mortgage itself.
Great success.
Next are decreased monthly outgoings. When you put money towards your mortgage in line with the lender's overpayment criteria, you will automatically see a decrease in the repayment costs. If your mortgage provider doesn't allow overpayments, then what you should do is save that money up so that when it comes time to complete your current mortgage contract and that you're remortgaging, you can use the savings that you've put away to pay the balance down to the provider, and this will ultimately reduce your mortgage value. From that, you'll also see those costs coming down as well. But when your mortgage payments decrease, what are you going to do with all that additional cash that you have each month? No, not that. No! Well, the intelligent thing is to then put that money back into working for you. So you can either pay off more of your mortgage every month or start to invest that money. And that's always a smart decision.
Boring.
And another reason to pay off your mortgage is for the fear of future interest rate rises. Many of the viewers to this channel and readers of my site will be in mortgages that were agreed before the significant rise in interest rates that occurred during 2022 and are continuing already in 2023. What this means is that when their current mortgage is due for renewal, they will see a substantial increase in their monthly repayment costs. It may also mean that many homeowners fall into a situation of being unable to afford their mortgage payments, both literally and in the eyes of the mortgage providers who will stress test your mortgage affordability when making a new mortgage offer. By paying down your mortgage, this removes or reduces the impact of any interest rate rise will have on your finances. Now, if I've already sold it to you and you want to rush out to pay down your mortgage, hold fire 1 second. There are some factors to consider. The first is, well, can you actually overpay on your mortgage without penalty? Because if you can't, don't do it. The second will be, when is your mortgage up for renewal? Because that will have a factor in whether or not you should pay it down. And finally, there is an opportunity cost of paying off your mortgage versus investing. And the first factor again is, can you overpay on your mortgage without penalty? Well, the good news is that usually they do. However, as the conditions of this are different with each mortgage company, it's up to you to check your terms and conditions and to make sure this is okay. It is common for mortgage overpayments to be capped at a certain percentage, and usually this is around 10% per year. However, when the overpayment threshold is reached, your mortgage provider may impose a penalty for any further overpayments, so be mindful that you don't overstep that. You need to ask whether your sum of money is greater than that current overpayment amount, and if that is the case, instead of overpaying the full amount, you might also consider investing it elsewhere at the same time. Secondly, we need to consider when the mortgage is up for renewal. Is your mortgage up for renewal soon? Well, if so, the mortgage costs could likely jump substantially from your current interest rate to the new rate when you remortgage. For that reason, you may want to pay down your mortgage so that the increased mortgage cost isn't just as high. But if you have a fixed rate mortgage with a relatively low interest rate many years from now, well, it might probably be better for you to hold off overpaying in favour of investing your money and gaining those expected returns. But don't get too worried about that this second. Later in the video, I'm going to compare the financial metrics of both so that you can then start weighing up the decisions and choose the path that's best for you. What are the risks of paying down your mortgage? Good news, well, there are relatively few risks to paying down your mortgage. However, before you consider this, you need to ensure that you've fully funded your emergency fund with 3 to 6 times of your monthly expenses. The major issue with putting additional funds and money into your mortgage is that you are putting it beyond your current reach. And you might just need that in an emergency situation. But an emergency fund mitigates this entirely. The second reason is that you're in debt and you have high interest loans, and the general best practice advice would always be to pay the loans down first before you pay off your mortgage or even think about investing. So I have to give consideration now to investing, and there is no denying that investing is a great alternative to paying down your mortgage. There are advantages and disadvantages that you should always consider based on your personal circumstances, and we're going to look at those now. Depending on the types of investment that you choose, you may generate a return equal to or greater than your mortgage rate. If, for example, you obtain a 5% return on your investments and your interest rate is 5%, then there is no benefit in choosing either investing or paying down your mortgage. However, many investments are likely to provide a return greater than your mortgage interest rate, especially if it's a low rate like 1.75 or 2%. And if this is the case, it would be financially more beneficial to invest the money instead. The second main advantage of investing your money is that it can be accessed easily. When you invest in stocks and shares, you can sell these at any time you want. Today, the process of both buying and selling investments is incredibly straightforward, and it can happen almost instantly. Some index funds may take a little bit longer, but certainly within a few days, you can access all of your money. What are the risks of investing? When you pay down your mortgage, you're guaranteed a return equal to the interest rate that your mortgage is set at. When you choose to invest, this will always carry risk. And ultimately, there is a risk that your investment value might go down. It could even go to zero. The choice of investment can include less risky choices, but this often comes with declining rates of investment return. And if you need access to your investment funds in an emergency, you are always at the mercy of the markets and the current value of the investments at that time. For example, during the pandemic, many investments decreased by 20, 30, 40, even up to 80%, and the majority of these have now recovered and much more. But if you needed to sell your investments when they are decreased in value, then you crystallize the losses for good. However, where there is risk, there is always reward. Now, I did promise I would share a recent client case study, and I have asked the client if I can do this, and they said yes. But they recently received a £5,000 bonus, and I spoke with them when they asked me the question of what they should do with their money. They had the exact same question: should they pay off the mortgage or should they invest the money? And I discussed all of the advantages and the disadvantages of each investing and paying down their mortgage, as I've explained above. And we also worked out the following plan. What we did first and foremost, outside of everything I've explained before, was I checked their debt, because normally what you should do is pay down any significant debt above your mortgage rate first and foremost. This client had some small loans of about £1,000 worth, and they had that remaining to pay over a couple of years. Normally, my gut reaction is always to pay the debt down first and foremost. However, the interest rate on their loans were only 1.25%, crazy low. At that rate, it didn't make any sense to pay down the low interest rate debt first. If the interest rate had been 10% or greater, there would have been, of course, a different suggestion, but to be honest, I'm still a little shocked at how low that interest rate was, and we just continued to pay that off monthly, and that was not a consideration, because it's unlikely that they'll ever get a loan at that low rate again. Secondly, I asked them about their emergency funds, and this client had a fully funded emergency fund that they were comfortable with. So again, in this instance, it wouldn't make any benefit to them to add more money to that fund in their circumstances. We then discussed paying down their mortgage, and the client is one of those lucky ones among us who locked in a super low 1.75% mortgage rate in 2021. It is fixed for 5 years and not renewing for another 3 years. They can overpay up to 10% each year without penalty, and the £5,000 that they had saved is within that limit. The decision then to pay down their mortgage would guarantee my client a 1.75% return on their bonus money when paying down their mortgage. It's not amazing, but it's guaranteed. The client was fully aware that the cost of their mortgage payments could rise significantly in the next few years when they remortgage.
Not on my watch.
For this reason, paying down the mortgage would brace that shock and reduce this a few years from now. Making a considered effort to reduce their mortgage further before that change will ensure that they keep to their strict budget every month when that time comes. I also had to ask them about investments and if they were already an investor. Now, this client of mine currently doesn't do any investing outside of their workplace pension, but they had expressed an interest in it and would like to educate themselves further. While investments can decrease in value, the expected annual returns of many index funds, stocks or shares would be greater than the 1.75% cost on the mortgage. If the investments can generate a greater annual return above this, then it would be financially more beneficial for this client of mine to invest over paying down their mortgage. So we had all of those considerations. We had the advantages and the disadvantages. We had the questions that I asked them directly about their own personal circumstances. And this was the plan that we came up with.
Now let's do this!
Based on my client's situation, it did seem prudent to put some of the money towards paying down their mortgage and beginning to build this as a habit in their daily lives. So every month they start putting a little bit more money towards their mortgage and overpaying that, because that's something that they will continue to do until that mortgage is completely paid off. However, we also decided to put some of the remaining money towards investments in a tax efficient manner.
Investing! I invest in the stock market.
Such as a stocks and shares ISA. At the time of the mortgage renewal, my client is going to look at their accounts and see if they want to choose to withdraw the new funds that are invested to pay down their mortgage further. They could, of course, invest their whole bonus, but investing over the short term does prompt greater swings in the value, and the investments could go down as well as up. Through talking to the client and understanding their money goals, the decision to split the investment and mortgage paydown is not just financial, but also part of forming positive habits of reducing your expenses and increasing your wealth through investing. The next step in the process is to start supporting the client in their learning of different types of investments that they can make within their own stocks and shares ISA. Now, you're probably saying to yourself that what are the alternatives to paying down your mortgage or investing? And since I spoke to that client, a number of the high street banks have significantly increased their interest rates within their high interest saving accounts. As such, they have now become a viable option over paying down your mortgage or investing. At the minute, for example, you could achieve the following interest rates from your high street banks. Within First Direct, you're getting a 7% return, Lloyds Bank 6.25% return, and NatWest 6.17% return. The guaranteed return would be significantly more beneficial to my client than a 1.75% return that they'd get from paying down their mortgage. But once that fixed rate is over, they can actually roll that money into further years, and if the rates are still high, they could take that money out at that point and overpay on their mortgage. So in reality, it isn't just as binary as paying down your mortgage or investing the money. There are other ways that you can now save your money too and generate decent enough interest returns. The choice to pay down your mortgage or invest isn't necessarily just a financial decision, but it's also steeped in emotion. Weigh up the advantages and challenges that you might face with the decision and create a plan that you are happy with. Remember, it doesn't have to be one or the other. If you're comfortable with doing so and it fits your financial goals, you can do both. And what I love about people asking this question is that the process of weighing up investing decisions like this and looking at the opportunity cost of both is something that you can use when you make decisions for the rest of your life. As always, thank you so much for watching. If you like this video and are still unsure about the best course of action, or you want to run your decisions past somebody who will be completely objective about it, I would be delighted to have a personal one-to-one financial coaching session with you where we can walk through the question and look at this from your personal financial position. To do so, head over to founder.co.uk where you can read all about the personal financial coaching sessions and book one with myself, Connor. And if you do want to continue the conversation, head down into the comments section below and you can leave a little message there also. Please do feel free to like this video and subscribe to my channel, and I look forward to seeing you in the very next video. Bye bye.